This is Jody Trana with Chapter 6, Part 1 of Principles of Accounting. You might think that inventory isn't that big of a deal, but listen to these stories. These are some of my favorite. Target back in 2015 was trying to make a big entry into the Canadian market. But the barcodes on much of the inventory, like these Barbie toy cars, didn't match the inventory numbers in the system. They couldn't even put the products on the shelf. The customers, of course, were not impressed with this new Target company with so much inventory missing. And the Target Canada company lost $2 billion, and it was shut down within a year. Walmart, you may know if you have ever shopped there, is always really bad at keeping their shelves stocked. It's been an ongoing problem. They've even hired outside companies to come in and just walk the shelves and look for empty shelves to notify them. Over the years, this inventory problem has cost them $3 billion, and they still struggle with it today. Nike has had an ongoing difficulty with their inventory management system. Unlike these other stories we've talked about, Nike has excess inventory and they struggle with having that excess inventory. Their inventory management system at one point had cost them around $100 million in sales because they weren't able to track goods. So they invested money in a new software system, but it had bugs and didn't work very well either, and they lost millions more dollars. Best Buy is one of my favorite stories. This happened a few years ago, but right during the middle of the holiday season, Best Buy sent out a statement saying, "We're very sorry for any inconvenience this may cause you, but your order has been canceled." And that's about all that they said. So during this holiday season, they had such a poor inventory management system that they had no idea what they had on hand. It only became apparent to them as they were shipping and selling their goods that they could not meet all of the orders that had come in, and they had to cancel a bunch of orders. They lost many customers at this point, but Amazon probably gained them, so it was all good for Amazon. And finally, Ralph Lauren. They have had so many problems with inventory management that their profits have plummeted 50% or more in the past 2 years. The company is now worth half of what it was before, and it's all because they can't get their inventory under control. I want to show you a perpetual inventory record. The first one I'm going to show you is for inventory that all costs the same amount. Here you can see on August 1 that we record that we have 2 items on hand that were both costing $350 each. On August 5, we purchased 4 more units. Those also cost $350 each, and now we have 6 on hand. On August 15, we sold 4 units. That takes us back down to 2 units on hand. August 26, we purchased 12 units, still at the same cost of $350. Now we have 14 on hand. And on August 31, we sell 10 units. That leaves us with 4 units on hand. If we total the columns, we can see that throughout the month, we purchased 16 units, we sold 14 units, and we still have 4 units on hand. From this information, we can calculate our dollar value of ending inventory. That would be our ending units on hand, which is 4, times our cost per unit, which is $350, for a total of $1,400 of ending inventory. We can also calculate our cost of goods sold. We take our units sold, which we can see in the quantity sold column of 14, times the cost per unit of $350 for a total cost of goods sold of $4,900. You'll rarely find a company whose cost of inventory never changes and always stays the same. Here you can see that we're showing the cost per unit actually increasing as the month goes by. For some types of businesses, it is common for the cost to go up. For some businesses, it is common for the cost to decrease. And then, of course, they're always going to change back and forth depending on what exact inventory we're purchasing. Because there are so many different types of businesses, there is so many different varieties of inventory, and inventory costs will vary so much. There are 4 different methods that you can use under GAAP, generally accepted accounting principles, in order to calculate your cost of goods sold and your inventory balances. You can see the 4 listed here. So why are there different inventory methods? Because of the size and quantity of products in inventory, it is necessary for there to be different systems that are acceptable under GAAP to use. Companies need to have a consistent method, but for some companies, one method may provide a more accurate view of inventory and cost of goods sold than another method. So companies will choose the method that works best for their industry or for their particular business, and then they will generally stick with that inventory method. The specific identification method is a method that companies would use if they wanted to track exactly how much their products are costing. A company that would use this method would probably have larger pieces of inventory that would be easier to track and to follow. Here you can see an inventory record that is kept using the specific identification method. For each unit in the inventory on hand column, you can see that we have to keep track of each unit at each cost. At one point on August 26, you can see that we have 3 different types of inventory that have 3 different costs on hand. If we wanted to use this method, we would definitely want the use of an inventory management computer system. Here you can see the totals circled at the bottom. So our total purchases for the month are $6,000. Our purchases go towards our inventory balance, but that's not how much is sold. You can see that our cost of goods sold column shows $5,200 that has been sold during the month. And then the inventory on hand is what is left, the $1,500 we still have on hand that we can sell. The next method is first in, first out. Because it is difficult to use the specific identification method for companies that have lots of inventory, we need to come up with a couple of options to track inventory that best suits a business and that industry. The first in, first out method assumes that the units that you buy first are the ones that you will sell first. So in this way, the ending inventory is based on the cost of the most recent purchases, not the oldest purchases. When we sell items, we're going to identify those as the oldest units in inventory at the time of the sale. So we'll remove the oldest units along with their cost from the inventory and leave the newest units available and part as the ending merchandise inventory amount. Let's look at an example of first in, first out for Smart Touch Learning. On August 1, we're going to say that they had 2 tablets that cost $350 each. On August 5, they purchased an additional 4 units. This time they cost $360 each. So at the end of the day on August 5, we had 2 units that cost $350 and 4 units that cost $360. On August 15, we sell 4 units. So what are the 4 units that we've sold? Under FIFO, the first 2 units sell first, the ones that are the oldest in our inventory. So each of the units at $350 we say definitely sell because those were first in. The other 2 units will be assigned from the August 5 purchase for $360. So that leaves 2 of the newer units at $360 left in inventory on August 15 for a total of $720. On August 26, we purchased 12 new units, this time at $380. So in inventory now, we can see at the end of day August 26, there's the 2 units at $360 that were purchased on August 5, and the 12 units for $380 that were purchased on August 26. One more sale happens on August 30, and this time we have to take again the oldest units, 2 of the units that are $360, and since we've sold 10 units altogether, we'll take 8 units from the August 26 amount at $380. The 4 units that we end up with at the very end of August are 4 that we say were purchased on August 26 for $380. You can think of this as having inventory on the shelf that you're always pulling from the oldest inventory, but we aren't really doing that. We aren't really looking for the oldest inventory and pulling it out. It's just a way for us to categorize and to identify costs using a specific method. Here you can see that our purchases are $6,000, our cost of goods sold are $5,180, and our inventory on hand is $1,520. These amounts are different than our specific inventory method. Next we have LIFO, last in, first out. This is very much like FIFO, but we, instead of considering the first in being the first out, with this method we consider the last in to be the first out. Here you can see the same inventory record, but this time it's being kept under the LIFO method instead of the FIFO method. August 1 and August 5 are unchanged. The first change that we see is August 15 when we make our first sale. With the FIFO method, we drew from our oldest inventory first. But with the LIFO method, the last in, first out, we're going to draw from our newest inventory. Our newest inventory is the units that were just purchased on August 5. So those are the 4 units that we're going to identify as being sold. And then the units that we still have on hand are the 2 old units that were on hand on August 1. When we purchase new units on August 26, there's really no difference. We just show that those are being added to our inventory on hand. But now when we show a sale on August 31, again, our 10 units that we sell come from our most recently purchased units. This time, they're from August 26, the $380 units. You can tell that because we're drawing from the most recently purchased and our prices on our inventory keep going up, that our costs of goods sold are going to be higher under the LIFO method than the FIFO method. And this is always true for companies who purchase inventory that keep gradually increasing in cost over time. The final method is the weighted average method. With this method, we compute a new cost per unit based on the weighted average of the cost after every single purchase. Let's take a look at how the weighted average method works on the inventory record that we were using for Smart Touch Learning. This record shows that on August 1, we had the 2 units at $350 for $700 total. No change there. On August 5, here we have our first change when we purchase 4 units at $360. We will calculate at this time our new cost of inventory. So our cost of inventory comes from taking our total units. So our total units are 2 units that we had plus 4 units that we purchased. And then we'll take our total cost, which is $700, plus what we purchased of $1,440. So we'll take that new total cost of $2,140 and divide it by our new number of units. And that tells us how much on the weighted average that these units are costing us. So rather than being $350 per unit now, we're going to consider all 6 of our units costing $356.67 a piece. Now on August 15, when we sell 4 units, we're going to sell them at what we say is $356.67 a piece. And what we have on hand are 2 units at that same price. Our weighted average unit price will not change until we make a new purchase, which we do on August 26. On August 26, we purchased 12 new units at $380 a piece. So it's time where we need to calculate our new cost, our weighted average cost per unit. So we have a total of 14 units on hand. That's the 2 units that we did have, plus the 12 units we just purchased. That's a total of 14 units. We need to also figure out the total cost of all this inventory. The previous cost of inventory was $713, but now we've purchased $4,560 more. So that's a total cost of inventory of $5,273. We'll take that number divided by the number of units that we have on hand of 14, and we come up with our new weighted average cost per unit of $376.64. That again will stay our cost per unit until we purchase more units. You can see on August 31, we have sold 10 more units, and we're using that new weighted average cost to calculate our total cost. You can see here that our total cost is $6,000. This has not changed at all from any of the methods, because what our inventory costs is what it costs. This is what we're writing the check for. But the cost of goods sold has varied between the FIFO and the LIFO method, and the weighted average method will fall somewhere in between.